right, show you guys what we're up to. So we are, as you know, and anybody who is new to the group, and Dave keep admitting people to the group. So we're the #1 network for Black professionals. So our agenda today is I'm going to go just a brief, like few minutes on Black Achievers and who we are and what we do. Then we're going to have an investment overview by Mr. Chris Bennett. And then we're going to have a kind of a deeper dive by Darren Carey on real estate investing and how his program works. And then we'll have a networking session. So we're kind of known for that. We're going to break off into groups of about 4 or 5 people. You get to know each other, get to connect and exchange information. And then we're going to do a brief presentation by Darren Reedus on a program that he's spinning up, which is a $100 million fund that our members can take advantage of on how to buy a business, an existing business. So we're very excited about that. And we'll be doing follow-up deep dive sessions with Darren in the future. And then we'll have a conclusion with next steps. If you would like some more information or how to invest in some of these opportunities you're going to hear about tonight, and Chris will go over that. And then if it's not too late and you feel like sticking around, we'll have an additional bonus session, networking section, where you can network with other individuals if you like to do that. We'll be right at 8:30 when that starts. So I'll go ahead and get started with us. So our mission at Black Achievers is to connect, educate, and economically empower the African-American community. Started in 2018. We became a 501c3 just in January of 2020. A little bit about me, I'm a native Cincinnatian with the Elder High School, UC grad with a degree in mechanical engineering, and I was a business owner of website development company for over 15 years, and I'm currently an IT project manager at Fifth Third Bank, and that is a picture of me and the leadership team before COVID in December of 2019. So the good old days. So metric-wise, about Black Achievers, we are the largest Black professional networking organization in the state of Ohio by far. We have over 4,000 members in just the greater Cincinnati area. And we have about 540 people who are business owners as part of our group. And we have established 12 community partnerships. We have a list of sponsors I'd like to thank. So Greater Cincinnati Foundation, Main Street Ventures just recently gave us a $50,000 grant to spin up entrepreneurship program. So you'll see more information about that. So if you're a business owner, we'll have lots of new information for you. Archwave, Seven Principles, Kroger, the Carl Ann Ralph Hale Foundation from US Bank, Gilman Partners, Leadership Council for Nonprofits, and Ignite Philanthropy. One thing I did want to shout out, because I don't know if Kelly Bonnell is on tonight or was able to make it.
She is in the room.
Oh, she is. Hey, Kelly, I'm going to have you speak to this. Where's Kelly at?
Oh, nice. Thank you. I'll put me on the spot.
Yeah, you can do it, Kelly. Well, I was going to speak to it. Go ahead. This is a great partnership we have here. If you wanted to speak about it for 1 second.
Yeah, absolutely. And sorry, I have a toddler running around in the background, or else I'd turn my camera on, which Michael, you know how that life is. Yeah, so thank you for giving me that couple seconds. So new this year for our grant programs is our launch grant, which is focused on early startup opportunities. So early stage founders, as we like to call it. So our purpose here is we want to make sure that good ideas can and will survive in the city of Cincinnati, the greater Cincinnati region, including Northern Kentucky. So feel free to apply if you've got a good business idea, and check us out at mainstreetventures.org. And the application closes February 26th.
Yeah, well, thank you, Kelly. And
thank you.
Yeah, so Kelly will be on our quarterly events, and she'll be giving more of an in-depth presentation, but these are $5,000 to $10,000 grants. If you want to reach out to us directly at grants@blackachievers.com, we can kind of aggregate everyone and then send you over to Kelly and her team, and you can ask any additional questions you might have. All right, and I'm going to turn it over. That's the end of mine. I'm going to turn it over to Mr. Bennett, and he's going to go through his presentation and get you guys up to speed. Hey, Chris.
All right, it is so good to see faces, see names. It's so good to have you guys on this night. My name is Christopher Bennett. I'm the VP of Investments, and this is our first inaugural investment meeting. So, you know, kudos, claps, all that other great stuff. What you see before you today is kind of the agenda we have for tonight. As mentioned before, we have an amazing opportunity to participate in real estate investing, particularly in note investing. We're going to go deeper into that. And one thing that is going to be wealth building, transformational, an opportunity for us to partner with the Chamber of Commerce through our good friend Darren Reedus to create more Black entrepreneurs through acquiring businesses. But before we go deep into both of those topic areas tonight, I thought it good for you to kind of bring you along the journey of how we got to where we are tonight. So, and Michael, keep me honest, I think it was back in December, the executive team got together and we had a strategy session around what this would be, what our mission would be, what our goals would be. And in that strategy session, we kind of came together and decided that one of the things that we want to do in conjunction with the other things that we're doing as Black Achievers, the other avenues of value we're creating for our membership, is to provide an opportunity for greater investment education and greater investment access. So starting in December, coming all the way into the new year, we were focused on kind of 3 directional areas. Number one, we wanted to create a platform for more folks like you and me to invest in opportunities that are not necessarily curated by Charles Schwab or Fidelity or any one of the other traditional finance houses. We wanted to provide access to diverse asset classes, opportunities you would normally be able to just pull down, put in a code or an email address into a website and be able to get access to. So that was one of the biggest drivers of what we wanted to create. Number 2, we want to continue the spirit of education. So many of you, just given the profile of our typical membership, are familiar somewhat with 401ks, 403bs, IRAs, et cetera, but there are opportunities to learn more deeply how you can leverage those assets you have to diversify your overall portfolio to really be able to hedge against fluctuations in the stock market or really tap into equity investments that you normally wouldn't have an opportunity to invest in. And then number 3, the broader vision that our organization has is to invest over $1 billion over the next 10 years. And we're placing kind of a floor on ourselves that any investment that we would present to you guys or we would participate as Black Achievers must at a minimum generate at least 10% interest or yield. So that is one of our big, bad, bodacious goals. And we see tonight being the first step in that direction. So if there are any other questions, if there are comments, if there are thoughts, please email us at investments@blackachievers.com. We would love to hear from you, especially as we move forward in the year and start pinpointing where we may want to have more education. And as I said, more opportunities to invest in asset classes that are not typically available to underserved communities. Without further ado, I'm going to introduce our first speaker and our first opportunity. Mr. Darren Carey comes to us as President and CEO of Dayton Capital Partners. As we transition, he's going to be sharing his own slides. One of the things I absolutely want to underscore to you is that, once again, our focus, our mission, is to create wealth-building opportunity in asset classes that are not typically accessible. So ask your questions, be thoughtful, be engaged. And so I'm going to go ahead and be quiet and allow for Mr. Darren Carey to come on and get us started.
Hey, Darren,
Hey, Chris,
welcome.
thanks for that intro. Hey, I'm going to pick on your slide there just for a moment. So just because on the bottom, it's going to scare the crap out of a bunch of people where you say 10% monthly returns. It's 10% annual returns paid monthly.
Oh, we'll
Slight
correct that.
difference.
There's a slight difference.
There is a slight
That
difference.
matters.
That matters. I'm sure you'll clarify on your slide.
I will. I'll do that. Let me pull those up over here. Because of course, you know, PowerPoint is always so cooperative. Okay, so just a little bit about me. I was in the military for 20 years. I retired out of the military in 2008, and I've been happily unemployable ever since. So in order to achieve that, I started buying rental properties while I was still in the military. Retired, went full-time into real estate with doing more rental properties, doing fix and flips, doing things like that. Got absolutely and thoroughly crushed in the recession in 2008, 2009. So I learned a ton from all those mistakes there. And then in 2013, we rebuilt everything from the ground with a really super solid foundation. So for those of you who are into real estate, you'll see I've focused initially on doing the rentals, then we added flips, then we added wholesaling. Then gradually we decided having 8 flips going on at the same time was a bit much. My wife decided we should have a life. So I kind of shifted over to the lending side where now I'm helping other real estate entrepreneurs go out there and do their flips and add to their rentals. And I get to provide them some of the funds to do that, but I also get to give them some guidance and mentorship in order to help them succeed in their endeavors. So that's what we're doing now. So in order to do that, I created the company Dayton Capital Partners. And when we go out there, we create these loans, and that's what gives you an opportunity to be on the back end and be able to get some of that yield. So first thing is a disclaimer. I'm not a CPA. I'm not an attorney. I'm just a guy that's been doing stuff and has learned a few things along the way. So if you have any questions, please consult with your professionals. Feel free to reach out to me. I'll give you my opinion. But again, I'm not a CPA. I'm not an attorney. I've never played one on TV. So what we're going to go through is we're going to talk about performing notes, which are also commonly called mortgages, but we're going to talk about private mortgages. So very unlike the ones that Fifth Third might originate to its customers, we're in a totally different game. So for those of you here, I'm sure there's some of you already note buyers because I know Chris is. I kind of scrolled through the list. I didn't recognize any other names there yet, but this gets interesting if you're looking at diversification, if you're curious about what we're doing, or just looking at it in general, because it's really an interesting area to get into. So just quick terminology. A note is simply the written terms for a loan that's given to somebody. Hey, you have to pay me back, you're gonna pay me this much interest, you're gonna pay me on these dates, etc. A mortgage secures that note to a piece of real estate. So if someone doesn't pay that note, I can take the property back. Now, ideally, I'll never have to take a property back. However, it has happened a couple of times, and I'm sure we do this often enough, it will happen again. So what becomes relevant is once I've originated a note, you can actually buy all or part of that note, and you can collect that interest and you can put that into your investment account. So it's one of those things where, at least I know when I was going to school, when I was growing up and getting started, I didn't even know this was possible. I thought the only place, did notes was, the used car lot on the corner and the bank. That's all I knew. But what we found out as we started originating the notes is there was so many real estate investors out there that were looking for those types of loans that I couldn't keep up with the funds that I'd put together from our flips. So one of the guys in our local real estate investor association asked me if I could help get some of his money out there from a self-directed IRA because he wanted to be in a note because it's more stable than being in the stock market, and he was really tired of dealing with tenants. So he asked me to do that for him. We kind of figured out how to do it, and that kind of became the basis for what we do now. So the reasons why he was looking into performing notes is he wanted that solid return. He wanted something that was collateralized or secured by real estate, and he didn't want to deal with the tenants, the toilets, the contractors, or any of those other hassles that happen. I've never had a note call me on a Saturday night and tell me the furnace is out. So it's a way to get involved in real estate without having to deal with all those day-to-day issues. And the great thing is you can do it from anywhere. Now, granted, that's the Cliffs of Moher behind me in Ireland. I wasn't on the cliffs, but we did close 2 notes while I was in Ireland, and they were back here in Ohio. And we were able to do that entirely remotely. So if you want to be an original note buyer, you can go out there and you can learn how to do it yourself. And I promise if you learn how to do it yourself, there will be mistakes and it's going to go badly, because when I started, that's exactly what happened to me. So the easiest way to get started is let an experienced lender originate the note. Once those notes are originated, you can pick through those notes and you can pick one of those notes or multiples of those notes, and you can buy all or part of that note. So you can spread some funds around 3 or 4 different places, or you can pick all of one, and you have that choice. Then you let the lender do all the servicing. So what happens is you pick a note, an ACH comes out of your account, you get interest payments back for a while, and ACH goes back into your account with the principal back when that loan is paid off. It's a very simple and straightforward process. So by comparison, Wall Street bundles notes. So I'm going to keep picking on Fifth Third because I know you got some of you guys on here. So they'll take all those mortgages they're selling to Fannie Mae, Freddie Mac, Ginnie Mae, whoever's buying them out there. They end up going through Wall Street, they get securitized, and they're resold either as mortgage bonds or mortgage-backed securities. Those currently yield somewhere around 3%, give or take, depending on details. So what's different with us is we're focusing very intensely on a single note on a single property with a single borrower. So that gives us a great amount of control and leeway over who we're working with. And that's what I like. I like having that control to pick and choose. So I talked to 1, 2, 3, 4 people today on the phone that were looking for a loan, 2 of which didn't even get past the phone call stage because they're not people I'm going to be able to work with for various reasons. So I can be very picky about who I work with. So we only lend to business-minded people. They're all real estate entrepreneurs. So most of them are rehabbers or flippers, just like you would see on HGTV. Although we have a lot less of the stage dramas, but we do get the occasional real dramas that do happen. So that's the majority of what we do. We also lend to some landlords who are going through the rehab phase. And we're just now starting to expand out, do some longer term notes for landlords who want to hold them long term, but they can't go to a traditional bank or traditional lender for some reason. It may be something as simple as they're an entrepreneur and they write off everything on their taxes. They tell the IRS they don't make any money, therefore the bank believes what they told the IRS. Simple things like that, even though they might have all kinds of cash flow coming in. The one thing we do not do is we do not lend to homeowners. Okay, that's a licensed activity. I only lend to business people and I only lend to people who are investing in real estate. And that's where we create our notes. So when somebody comes to us, the first thing they do is they go through that phone interview. I'm evaluating that borrower right out the gate. Who are you? Do you have experience? What are you doing? I'm going to talk to them a little bit about the property. I'm going to kind of put the pieces of the deal together, see if the deal works. Does it make sense? And then I'll take all of everything from those interviews and I'll go back and do the thorough due diligence. I'll do the background checks. So here's a little bit of detail on there. When I evaluate the borrower, before I even take that application, I'm doing a phone interview with them. After I get an application, I'll check their credit, I'll check their background, I'll check their experience level. I want to make sure they got the money to close. Because really what I'm trying to determine is one thing: can they pay back the loan and will they? Because just because they can doesn't mean they will. I got a property back just because of that. Next thing I'm going to do is evaluate the property. I'm going to look at the rehab, the cost, the accuracy. Is the rehab appropriate for the property, the size, style, the location, the price point? Can the borrower handle the rehab? And it was those 2 reasons that I rejected both of them today. The one project was way over their head, and for the other one, their numbers were just plain wrong. Because what they had for an after repaired value was not accurate. So what they were going to sell it for after the work was done. So I didn't even get to, whether they'd be able to sell it, even though they couldn't because the price was off. Just numbers don't work, so it doesn't pass. And then one of the things I look at is if this loan does go bad, do I want that property? Now, ideally, I would never take a property back ever. However, if they force me to, I will. And if I do take that property back, is it one that I can put into my portfolio? Can it go into one of the note buyers' portfolios, or are we just going to sell it outright to another investor and let them have that? So all that just goes into looking at the numbers in the plan. Do the numbers work? Does the plan make sense? Does this go together and does this work? Then I start tying the 2 pieces together with the borrower and the deal. Sometimes you have a good borrower, sometimes you have a good deal, but the 2 don't mesh. They don't work together. So I've got to watch out for that. And I go through everything. What's good and bad about the borrower? What's good and bad about the property? What's good and bad about this deal? And then I know y'all know what I'm going to talk about is you have that little gut check, that little queasy feeling you get in your stomach that just something just isn't right sometimes. First thing you learn is you always listen to that and you dig deeper. There was a deal in Norwood that I was going to do. And when I went and did the site visit, I found out some things that caused me to do some more due diligence and found out that a large part of what the guy told me that sounded great from his sales pitch point, most of it was a lie. And so that deal was, axed really quickly. And we also axed it for a couple other people that he was talking to, trying to get funds from because, well, It was fraudulent. He's now running, he's holed up in North Carolina, and the state's, kind of chase him down a little bit. So I'm still tracking that one periodically. Am I willing to do this deal? And if I did this deal, am I willing to keep that note? Because I'll never do a deal if I'm not willing to keep that note forever. So it's got to get through all those criteria. So it's a lot of things that you go through just to say, yes, I can do something with you. Then you got to get through the rest of your due diligence. You got to coordinate a closing. You've got to do the title review. Is the title good? Is the chain of title accurate? Do we have insurance? Or get all the documentation in place? And sometimes it will fail at that point also. There might be problems with the title where there was a bad transfer at some point that has to be corrected. So there's a lot more work that goes into that piece. Fortunately, once you get done through all that and you actually make a loan, it gets easy 99% of the time. The borrower makes their payments. I just pull it straight out of their checking account. They periodically reach out to me and say, hey, I've done a bunch of work. Can I get reimbursed for it? Because when I do the loan, I don't give them all the money for the rehab that goes into my escrow account. And we work it through there. We look at their scope of work. Does it match? Does the work they do, does it meet the building code? Is it functional? Is it usable? And sometimes the borrowers get some little surprises when they find out that their plumber did everything wrong because they weren't actually a licensed plumber. So we actually go out there. Sometimes we're out there helping the borrower when things go wrong. 20 years of real estate experience goes a long way for helping a borrower. It'd be hard pressed to find some problem I have not seen or figured out how to fix. And if I don't know how to do it, I know who to call. So in order to structure this and make this available for other people, because just as a single note, if I wrote a note out for, $150,000, that could limit the number of people that can invest in that note. So we put each note into a dedicated personal property trust, and the trust is actually the lender on that note. So it does a couple of things. One, it allows all the note investors to be anonymous. Nobody knows who you are. And that was really important to some of the guys that I initially worked with, because they were really tired of potential borrowers calling them. And one of them really said that, the piece of cake was when somebody called him that he didn't know on a Friday night at 10:30 p.m. looking for a loan on a property. And that's kind of when he hit me and said, all right, that's it, I'm done. You take over. It's the simplicity of it is, it's very easy for me to slice and dice that property trust pieces. We call them a beneficial interest. It's very easy for me to divide that out amongst multiple people within one note. And by creating the partials this way, everyone shares in the risk of that one note at an equal level. So everyone shares in first position. If you did traditional partials, you create a first, a second, a third, a fourth, and you could get your position wiped out. Just like back in the crash, a lot of second mortgages got wiped out. They got nothing. We set it up so that can't happen. So, and then because it's in a trust, the trustee takes care of everything, and I am personally the trustee. It's not even the company, it is me personally. So if something goes wrong, you call me. But, all that said, there's risk. It's an investment. There is no guarantee. This is not an FDIC insured bank account. While we do our best to vet the deal, the property, the borrower, and everything else, some will go bad. I've been fortunate. It's been 2017 was the last time one went bad on me. And that was also when I changed my lending standards did a look back and said, I've had 4 or 5 of these things go bad. What did they all have in common? And so that no longer gets past the gate. But even though that's been, 3.5 good years at this point, I promise another note in the future will go bad. And if that scares you, then this is not for you. Okay, so we talked about lending to real estate investors. So typically, most people are coming to me for what we call a hard money loan. And that's a loan where we're funding part of the purchase and all the renovations for the investor. So they're required to bring in at least 25% of the purchase price as a down payment. So if they're buying it for 100 grand, they're putting $25,000 down. I want them to have skin in the game. Now, if you get into some of the areas, Price Hill, parts of Dayton, things like that, you get some relatively inexpensive properties that need a lot of work. We do have a minimum of 12.5 just because, again, we want them to have that skin in the game. We want them to be motivated to make sure this is going to succeed from their perspective. Another thing we look at is by the time that they're done, that the overall project is going to be 70% or less on the overall loan to value. So it's creating equity over and above that note so that if something does go wrong, there's a level of protection there. Now, usually we fund 100% of the rehab, but we don't give that to the borrower right away. We set that aside into an escrow account. So that way the borrower is not upside down in the loan, and they can draw off that escrow account as they get work completed. So it's very common for me to get a call from a borrower a week or 2 weeks after we've closed the loan, say, hey, I've done the trash out, I've got the demo done, and there's a new roof on. Here's the invoices from the contractors. I need $12,500. And we'll go verify those things are done, the invoices and a few other steps, and then we'll give them that funds for it. They do not get funds in advance. So those notes are written for a 12-month term. On average, they pay off in about 7 months. Sometimes I'll know ahead of time it might go a little faster, it's going to go a little longer. Because if they're going to the bank to refi as a rental loan, they might need 12-month seasoning. So it might go for 13 or 14 months to get that seasoning so they can refi and get that really low rate. So it's something we can use to help guide, how long do you want funds out there? Now, each hard money loan is by definition priced individually, but the ones I've been doing lately, all those have a yield of 10% to the note investors. So it is a good yield. And that's where, Chris's 10% came from. So that's what Chris is getting on some of his notes right now that he has. Yeah, I had to throw you under the bus there, Chris. So we're also moving and doing a few more of the rental loans. And these are a little different. These are the ones where they just, for whatever reason, they can't use the bank because they don't quite fit that box that they got to fit in. These are always at 70% or less loan to value. Most of them are actually between 50 and 60%. They must have at least $20,000 equity in there. They've got to have positive cash flow. That term is 3 to 30 years. So you could actually get something in there and drop it in there for a really long time and just have that coming in all the time. Currently, the yields on those are running somewhere between 6.5%. They'll vary a little bit more depending on how much equity there is, the experience of the borrower, and the cash flow, and some other things that go on there. So there's a little more variability in those. So this is why I ended up in performing notes and why other people have hit me up and started getting into notes. You get solid returns out of it. It's secured by real estate. In order to make it go down to zero, you'd either have to, nuke it or, find a, some, brown site or black site, from something. You don't have to deal with the tenants. You don't have to do toilets. You don't have to deal with contractors. And it's very flexible. You can do it from anywhere. You can pick a note while you're out. You could be out on the beach in Puerto Rico. Yeah, that's where we were. And you can pick out a note from there. So I've designed this from the ground up so that me as a lender, I can do it from almost anywhere, but so the note investors too, they can do it from almost anywhere. Go out to Vegas, gamble with some money, invest the rest. So that kind of covers the canned part of this presentation. I went through it relatively quickly, as Chris asked me to do, but I really like going through the Q&A piece. So there's a couple of things here. I've actually written a detailed guide. It's 12, 13 pages long. It's not a long read, but it goes through a lot of things I've already kind of mentioned on here, but it gives you a little more detail. You can either email me at guide@daytoncapitalpartners.com and get that, or Chris has put it up on the blackachievers.com/resources page. So you can. So those resources are available to you. And let's see. Oh, I'm unmuted again. Now, Chris asked me to put together one that kind of met what Chris's criteria is for what he's looking for in a note. So this one's local. If you can see, it's in Franklin. If any of y'all know where Red Lion or 5 Points is, it's right there. I don't know why that part's Franklin, but technically that's Franklin. But here's a typical brick ranch, nice little house, good ARV, $175,000. The end loan to value will be 53%, so a lot of coverage there. The yield on that to the investors is 10%. The borrower's put $20,000 down on the purchase, so he's definitely got skin in the game. That means the yield back out to the investors, if I did the math right, is 775 divided by, however much is in there. So if you look at the very top here, you can see that overall note that we wrote up is $993,000. So in right down here, you see just a quick summary on what this property is. It's a structurally solid, it's a brick ranch on a slab, they're really hard to hurt, but cosmetically, it's still kind of original inside. It's stuck in the 60s. So if you wanted to go watch I Dream of Jeannie, it looks just like that. So it needs a complete update. But now this one here, they plan on flipping. They're going to sell this one retail. Now this specific borrower, he's done 5 properties in the past 2 years. They sold 4 of those and they've kept 1 as a rental property. And this is their 6th loan with us, so they have a track record. So as you can see, I've done every loan for him for every property he's done. So I took a chance on him for the first one out when he was still newer and kind of helped him along, and he keeps coming back, which is good. And then all the payments on his previous loans have been on time. He's a really good borrower. He's one of the kind of guys I like to work with. He's professional, he's on top of it, he's taking care of things, so those are the kind of people I look for. And if I have to start them off from scratch and kind of, nurture them along a bit, we do that. I mean, helping people along is part of what we do. I just closed on one in Covington, just across the river a couple days ago, and that person I'll be mentoring along the way. It's her second investment property. The first one was a light rehab. This one's heavier. She's a real estate agent in Cincinnati, but it's a big project, so I'm going to be giving her some additional help to make sure it succeeds for her. Okay, so I'm going to open up to questions. I can scroll back and forth the slides and hit them up. I'm sure there's people out there that have them.
Absolutely. And before the questions come, we're going to be a little bit adventurous for this segment. We're going to open up the mics. But I do want to share with our group that the leadership team has invested in this deal. So of that $93,000, $22,000 have already been spoken for. So that's our demonstration of how confident and committed we are to this particular deal. But more broadly, more importantly, creating access to non-traditional asset classes that we think will be a great addition to anyone's portfolio.
Just a quick note, Darren, there's a question in the chat. I think you should have access to it, but it's if you can see it, I can read it to you.
I was just trying to pull up the chat. It's kind of hidden under the slides.
Yeah, so do you complete annual portfolio reviews of the notes? That's the question.
I do look at each of the notes. However, most of them are paid off before they get to a year. So that person asking that question is a banker, because that's what they do. So yeah, I maintain contact with all the borrowers all along the way. If they are running, because if you notice the term on these are 12 months. So if we're getting close to 12 months or they're not calling me for draws, I'm reaching out to them already. I don't wait for that full year, because if there's something going wrong, I want to know right away so I can get it back on track with them.
Okay. And then Dr. Jackson said, how much money was needed for a rehab of the last property?
This one here, hang on, I'll pull up that exact, let me go to my other window. I'll pull up the exact number.
Okay. And then M Shuttle said, did we invest as a group? And yes, as a leadership team, we invested as a group, but as Black Achievers, we'll be investing as a group. So that's kind of the point. You can reach out to Chris, send us an email, and we'll aggregate everyone together so we have a clear understanding, and then you can invest in this property as well if you like.
And just a quick point, this opportunity here is an actual opportunity. So this is something that is available for the group, anyone on this call to invest in if they want. So you can ask questions afterwards if you like.
Yeah, this is real. This note officially closed on January 22nd. So yes, very recent. They have a $35,000 rehab budget, which is currently sitting in my escrow account. They do not get access to that money until they've actually completed a portion of the renovations. One of the things I had to do was I had to carve off one of these to hold for you guys, because if I put this out to the list, that list is, it's gone a lot of times in hours, and I'm not exaggerating. Yeah. Chris, I know you've seen it happen already when you've tried to reach out and you were a little slow.
I've seen it too.
Yeah, so just so you guys know, we were very intentional to try to curate and pull out a deal specifically for you. I saw one of the questions pull up the minimum because of our relationship on this particular deal and hopefully future deal is $600. So we help work to try to make this as accessible as possible.
And that's an experiment. I'm doing this for you guys only right now. And no, it's not a sales pitch. This is real, because I'm working on automating processes, and right now parts of it are still very manual. So I need to make sure this works and it flows well. So you guys are, we'll make it all happen. You're kind of guinea pigs in one sense, because you're kind of going through it. as a new process. I know the leadership team's already started through the process. I've got them about 90% of the way there. They've got one more form to fill out, and they will be invested in that note there, and they'll get that one from me tomorrow. Normally, I would have a minimum of 5K on there, although I always had an exception for people with CISA accounts and HSA accounts of down to 2K, because it's a processable, it's a level that I could work with. One of the things to mention, I know Chris, you had mentioned, alternative sources, is the good thing about the notes like this is you can do it from any account. So it can be your checking savings account. It could be a business account. If you have IRAs and 401ks, they would have to be self-directed. They can't be with your company unless you run the company, but you can invest in those also. So I run my own company. I have my own 401k. My 401k invests in notes. But if you work for Fifth Third, I'm pretty sure Fifth Third's not, or P&G is not going to let their 401k invest in notes. They're going to make you go back to the stock market and just play with the Wall Street boys.
Okay, so we have a couple other questions here, a little detail. Can you explain the difference quickly between notes and tax lien certificates?
Yes. So both of those are a lien on the property, but on a tax lien, the county has gone and sold that lien to a third party. So like in Montgomery County, it's usually taxis. Now that lien is if the person who owns the property, if they don't pay that tax lien, whoever owns the tax lien has the right to foreclose on that property. So it's not a loan. It's basically it's an unpaid tax bill that you bought the right to. It's almost closer to factoring, more so than real estate investing.
Oh.
If anyone's familiar with factoring.
Okay, thank you. And then you send out a list of properties. So when do you send out that email, and is it on a regular basis?
Yeah, right now it's an email list. We're working to push that online. However, we send it out about once every 3 weeks or so, or about the time we accumulate somewhere between $500,000 and $700,000 worth of notes. Then we'll go and send that out to the email list, and I process the emails back in the order received. So we tell people, if you're going to send, when you send an email back, tell me what you want, but also tell me what your backup choice is too, because I'll process those in the order received coming back in.
So the next one's kind of for us as a group, but it says, can we invest both as an individual or through Black Achievers? So we're all investing as individuals, although we're coming together as a group and reviewing the property and deciding which property to invest in, Toriana. But when you actually do the investment itself, after we've decided as a group, say, hey, this is the property, you decide how much you want individually, and you sign the paperwork individually. So it's an individual investment, but a group kind of discovery or process to get to what we're going to invest in. And that's the way we've done it.
Okay. Yeah, and for the first one, it's probably the easiest way to do it that way, to focus on one property. And again, Chris and I kind of picked this property because it met Chris's criteria for what he thought was an investable property.
What is the deadline to invest in this specific property here?
That's a good question. I didn't set one.
Yeah, Brian, right? Okay. So Chris can answer that. He would like you to reach out.
What I would say is, and Darren, I can confirm, I think we may hold this one, if he's okay, with at least 2 weeks of exclusivity, meaning that Darren can say, hey, I'm only taking Black Achiever investment amounts for this particular property, but after that point, you still can invest if space is available, even though it's likely it won't be. But if Darren's okay with the 2 weeks of exclusivity, I think would be appropriate.
I can do that for you on this one. Yeah, because if I put this out on the list, it'll be gone in 10 minutes.
Yeah.
Everyone on the list likes the properties like this. Those are gone.
Okay. Jimmy McCrae says, is Black Achievers investing as an investment club, or what is the payout period? So like I said, we're just doing the picking as a club or as a group, but the investment itself is you as an individual after we've kind of narrowed in on a property, at least in the beginning.
Yeah.
And the payout period, you can explain that, Darren.
Yeah, so the payout period, so let's, for example, you get your investment, we get it funded, let's say it's February 5th. All right, so next Friday. We'll take that first month, the interest is prorated out. So you would get the interest collected from the 6th through the 28th, last of the month. And then I collect the payment from the borrower on the 1st of the month. So the 1st of March is when I collect all the February interest that they owe. I process that in, I give it 1 week to make sure I don't have any, returned ACHs or bounced checks or any of those bad things, which rarely happen, but do once in a while happen. Usually it's an oversight on their part. And then I send the payments out to the note investors exactly 7 days after the first business day of the month. So for February, excuse me, I'll pull payments from the borrowers on the 1st. Payments will go out to the note investors on the 8th. If you bought in during February, so let's say the 5th of the month, you'll get a prorated payment on that first month. And then each month after that, you'll get a full month's interest until the last month when it gets paid off, in which case it'll be prorated again.
Got it. So are these deals for accredited investors only? And what is your target monthly IRR?
I hate IRR.
Well,
That calculation drives me nuts.
Yeah, I don't, that might be, that's over my head, so, but at least
So-
it's not for accredited investors only.
No,
So
it
let's
is,
address
we
that.
structured this deliberately so you do not have to be an accredited investor. So, and the good thing is because it's an investor loan and it's short term, they do not fall under SEC purview. So we don't have to worry about a lot of that. So it makes it very accessible for everybody who wants to do it. However, we need to make sure it's also appropriate for you. If you've got, your emergency fund, this is not where you want to put your emergency fund. Your emergency fund stays in the bank and the savings account where it's supposed to be for emergencies. This is an investment. You need investment money going into there.
Got it. So what are Chris's criteria, a couple of them for investable property?
Okay, Chris, why'd you pick this one?
Absolutely. So I have been investing in notes for about 3 or 4 years. Recently, probably within the last 6, 12 months, started working with Darren. And I try to keep the criteria focused, but make it simple. Tell it to my 5-year-old simple. Number one, I work with Darren and say, I want to work with a borrower that you worked with before. So I wanted to have someone where there was an established history, on-time payments, that he's been able to validate their experience, and the validation has been in the proof of an actual deal, start to finish. So that was number one. I want someone who's worked with you. Number two, I want someone who's had experience. So not just someone you kind of starting along the way, but I want to look at someone who has experience. So 4 or 5 flips, or a landlord who's renovated a property, et cetera, et cetera. The third thing I thought would be good for the group is to have a property that's closer to Cincinnati. So as Darren probably shared for the questions I asked, he has properties that go as far south as northern Kentucky, or as far north above and around Columbus, or within Dayton. So I wanted to have a property that would be somewhat in a 30-minute radius of Cincinnati to kind of get some level of familiarity. And then I think the last piece was just wanted something that would, I think, where the strategy is for there to be a retail sale. So in this area, this Lebanon area, you typically have a low day on market for new homes that are coming on market. So an area where the strategy makes sense, 1, 2, a borrower who has experience doing what he or she is doing. Number 3, someone who has been working with Darren before. So that was the simple criteria for, I think, a good opportunity to present to the group.
Right, and
And
to
a
that,
quick clarification. Just a quick clarification. Even though it's local, because we're here in Cincinnati, Ohio, you don't have to be in Cincinnati, Ohio to invest. You could be in California. It would work fine.
Yeah, I have some note buyers that live down in the Carolinas. I've got some from Florida, got some from Michigan. Yes, we let them invest in Ohio. It's okay.
Mhm.
So we do that. Now, in addition to Chris's criteria, I added one other thing is I didn't want to present to you guys a big, ugly, scary rehab. So I didn't want to do one of those because we'll fund them that are, $100,000 rehabs that need everything. I didn't want to put that out there for this first one. That's just, those do get scary.
We appreciate that.
I saw Hope had a question in the chat. So $600
Yeah.
investment would yield $60 for a year, but it's paid monthly.
Right, so it's not $60 per month, Hope, it's $60 divided by 12, right?
Correct.
Yeah.
So it works out to $5 per month. So 10% yield still, what is it, about 10 times what a savings account pays nowadays?
Right. Got it. What's the next one? How do you find these properties? Do flippers bring them to you?
Yep, I've set it up so the flippers are bringing them to me. So that's where, I'm out at the Real Estate Investors Associations, the webpage, Bigger Pockets, they find me on Google. So I'm having the borrowers find me and ask me if them and their deal is a good fit and would I fund them.
This is you guys will soon find that this gentleman is not one who needs much introduction. But before we give him the stage, one thing I want to share with you guys is in building or identifying opportunities for wealth building, business ownership has been one that has sometimes been fleeting for underserved communities. We are familiar with stories of people starting in their kitchens, starting in their backyards, starting in their garages with ideas. But one aspect of building wealth through business is actually buying an existing business, a business that's already generating millions of dollars. And what I want to share with you guys is a vision, if you will, a story. And because my brother in Christ, Tory Frank, is on the phone, on the line, I use him as an example. He has been doing a phenomenal job at his company, knocking out quarterly targets and goals, managing teams, and he has been able to reach some of the heights of his company that people that look like him do not reach. And even though he is comfortable, his family is comfortable, his family is comfortable, he still feels somewhat unsatisfied in the role that he's in. And he feels called to go after an opportunity that just won't make him comfortable, but will truly make him wealthy. What we're going to be talking about tonight, guys, and what Darren is going to be laying the foundation for tonight is the opportunity and partnership we have with the Chamber of Commerce to build a pipeline for Tory to take his talents and gifts and actually be CEO and president of a business that is blowing it out the water here in the greater Cincinnati area or beyond these borders. So we started out this journey, actually Michael and Darren did months ago. And what we discussed were the 4 biggest barriers to individuals like yourselves in actually buying a business that's throwing off some serious cash. Number 1 is awareness. You mean to tell me I can buy a business like this? That's one thing that we're seeking to address as we talk about this relationship with the Chamber and with Darren. Number 2 is capital. Now, I would love to go buy a multi-million-dollar business, but I ain't got multi-million-dollar assets. How do I navigate that? We're going to address that. 3rd is deal flow. So, okay, I make this decision to go on this journey. How do I identify the companies? And then last but certainly not least, support. So now that I've identified a company, I've been able to pull the capital together to acquire it. How do I continue to grow this company and be successful, not only as an entrepreneur, but as a CEO? So I will now be quiet. I've done my best to kind of give you some context into the vision of what this relationship is going to look like. And like I said before, without further ado, Mr. Darren Reedus, please open up and educate us.
Well, thank you, Chris. I appreciate that. You hear a lot of folks talk about how excited they are to join a discussion and be the speaker and such. But I would tell you, rarely have I been as excited to participate in something as I am here tonight. And I'll go into why, at least begin to give you some of that. I have been put on a time limitation this evening, so you won't get the full gist, but in the next 15, 20 minutes or so, help to kind of set the stage for, as Chris very appropriately mentioned, a journey together. So really we're trying to use today as an opportunity for the Black Achievers team represented here tonight and on this call to begin to get to know me and some of the work that we're doing. Of course, there's going to be a multitude of questions. And so I am told, and Michael and Chris, stop me if I'm wrong, that in the very near future, we will have a sort of dedicated deep dive of this work that we will just dedicate the full hour plus to all the nuances of buying businesses and everything else that we're doing, but really looking today to sort of set the stage for some of that and begin the relationship building process. So am I accurate that we have a deep dive coming up soon?
Absolutely. I'm going to give you guys the preview, the trailer. February 25th, put it on your calendars. It's going to be all business all the time with Darren Reedus. So that's the plug.
So given that, and so I don't know if the slide is up if, folks can see me or not. I really, not that, you need to see me per se, but I did want to have this as more of a conversation, get to know you session. I know sometimes with the slides up that might, get in the way of, what you can see on the screen. I really, again, I'm looking at today to set the stage a bit in advance of that deep dive session coming up, give a little bit of background on myself, background on the work that we're doing at the Minority Business Accelerator, a little background on this $100 million fund that we are in the process of launching, and then a little snippet on, basic deal structure. So I'm going to try to get through those sort of 4 or 5 key points here by 8:30. And so in terms of a little bit of background on myself, I am now 5 years into Cincinnati. In fact, it was 5 years at the Chamber, January 19th. I relocated here from Cleveland. For those as have not heard that, if that is a bad thing for you, I apologize, but I am in fact from Cleveland. And so, but I tell you, it has been a phenomenal kind of transition here. I wasn't in any way unaware of some of the great things happening here. I did a lot of work with various ones in Cincinnati in my time in Cleveland. Real quick snippet on my background. I have been at this now. It's hard to believe. I came out of school and started working at National City Bank in 1988. So I was a banker, ended up being a banker for about 16 years. And so ultimately ended up running business banking for KeyCorp. Most of my stint was at National City before PNC acquired them. Spent about a year at Key running business banking for Ohio, Michigan, and Indiana. And I would tell you a little glimpse into me personally. I probably, like many of you, got to a point in my corporate career where, for all intents and purposes, from the outside looking in, things seem great. I mean, 2003, I'm going back 17 years now. I was, 37, senior VP, flying around on corporate jets, and for all intents and purposes, life was great. But I felt a bit of a void, finding myself frequently as the only person of color in all the rooms that I was in, and began to ask myself some questions about that. And frankly, then began to pray about that. And so ultimately decided to, take this entrepreneurial journey myself. I left banking after 16 years, and for all intents and purposes, a great career and much more to come. I would tell you, my father thought I was insane. I don't come from a white collar family. My dad was a 30+ year mailman, putting myself and sisters through college, and couldn't believe that his son, after all of his work, would have the audacity to leave a 6-figure job. And so we had some issues there for a while, but I think as time has gone on, he's appreciated my decision. But nevertheless, I took the entrepreneurial leap, started a outsourced kind of CFO group when I first came out of the bank, and took a couple of my banker friends with me, if you will, and we began to do the things for small businesses that I saw when I was a banker that they had a difficult time providing, timely financial statements and projections and all the things that, bankers would typically ask for business loans. And so I did that for about 3 years. And so at the time, there was an organization that was just getting off the ground in Cleveland called Jumpstart. Cincinnati's equivalent to Jumpstart is CincyTech. And so it was one of the country's first tech accelerators, happened to be in Cleveland, more from necessity. Cleveland, with its well-documented economic challenges, just decided to, how do we start creating new companies? And so this Jumpstart group was created. I started sending some of my entrepreneurs that I was working with in my practice to Jumpstart. Condensing a very long story, Jumpstart began to kind of court me and it was clear to see the trajectory of that organization. So after about 3 years, I ended up joining Jumpstart as their Chief Economic Inclusion Officer to help prepare more people of color and women for angel and venture capital and all the things that happen in the tech ecosystem. And so, identifying more minority angel investors and everything else that goes along with that. So about 7.5 years of it, which also was taking me on a pretty amazing journey. This has absolutely been a faith walk in a lot of respects. We'll learn more about that together as time goes on. But as part of my work at Jumpstart, we started doing some work nationally with the Economic Development Administration, some national foundations, and I began to, advise and inform some of this work on a more national level. Ended up leaving Jumpstart. The entrepreneurial bug bit me again. Formed my own consulting practice again. Jumpstart became my first client, and I started advising organizations like Jumpstart and communities on how to be more inclusive with the whole tech ecosystem process. And so, condensing a long story, 3 years of that, I was doing a lot of work in Detroit and other places, and found myself at a point where, while advising communities was great and all, you find though there are different levels of readiness and willingness to really get serious about inclusion. And so I was, back to prayer again. If I could just find a community that I could just do the things that I'm suggesting others do, and then have the country come to us and say, how did you guys make that happen? That became my next phase. And so believe it or not, I found that community here in Cincinnati. And as an outsider coming in, you may not fully appreciate all of the great things that are already happening here. And so I had my own little mental checklist of what I wanted to see in terms of a foundation that I could build upon. And so lo and behold, at the Cincinnati Chamber was this initiative called the Minority Business Accelerator. It's now in its 17th year. So I'll shift to the accelerator conversation here real quick. It's now in its 17th year. Got launched in 2003. For some, this will be review. For some, perhaps the first time you're hearing this, but was actually birthed out of Cincinnati's own civil unrest back in 2001. This was one of the sort of primary initiatives that was a byproduct of how do we begin to solve for some economic root challenges that are at the root of a lot of our disparities. In this particular case, how do we create more quote unquote larger scale African-American owned businesses? And out of the gate, it was exclusively focused on the African-American community. The Latinx population was added some years later. To be very specific, it was looking for minority firms, African-American firms with at least $1 million in annual revenue today at their starting point, if you will. So this was not focused on startups. Companies have to have at least $1 million in revenue, B2B or B2G business model. So this was then and now rooted in how do we create more diverse suppliers that could be in the supply chain of our corporate community, our P&Gs and Krogers and Fifth Thirds and others. So they had to have some minimum capacity to begin with, again, defined at $1 million. And so at the time, there were about 20 companies that began that journey. Fast forward, over 70 have now gone through that. What I inherited was a collection of companies that were doing in aggregate over $1 billion in aggregate annual revenue. Created about 3,500 jobs since that work began. I was in part charged with taking it to the proverbial next level, which we defined as growing by an incremental billion. So let's double that aggregation. Let's grow by an incremental billion, and let's create 3,000 more jobs in a shorter time frame, which we defined at about 5 to 7 years. To get to that incremental billion, we've created a 4-pillar strategy. You'll hear much more about this as time goes on. And as a follow-up, I will send materials that describe all of this. I'll route that through Michael and Chris. But our 4 pillars are basically these, in the spirit of what we call grow, build, attract, and create. Our grow pillar is fundamentally the core work that it's always been. Let's grow our current companies of size to their next level. So if they're already at 5 million, how do you grow them from 5 to 10? If they're already at 10, how do you get from 10 million to 20 million? If they're already at 20, you see the routine. And there's a bunch of tactics up under there. And so a lot of people don't realize, quite frankly, that there's over 70 African-American and Hispanic firms north of $1 million in this community. In fact, the average revenue of that group is actually closer to 25, 30 million. And so, but the grow pillar is just about let's grow our current companies to their next level. Let's create more $50 and $100 million African American and Hispanic firms. The build pillar is let's build a pipeline of emerging minority firms. These are companies under $1 million that we believe have high growth potential. And in fact, over the past several months, we've been highlighting about 12 of those pipeline companies in the Cincinnati Enquirer. If you guys have not seen that, I can share that link again through Chris and Michael as a follow-up. But this is trying to identify at least 10 emerging minority firms a year, or 50 over 5 years, to create more $1 million and better African American and Hispanic firms. So that's the build pillar. The attract pillar is work we do with an organization called Ready Cincinnati, trying to attract more minority firms here in gaps of where we don't have them. So we look at where there is an opportunity, perhaps. I'll give you a quick example. There was a company out in Kansas City that specialized in public sector work, a lot of federal contracting with the Department of Defense and Environmental Protection Agency, et cetera, which was a huge void in Cincinnati. We have worked with that company to have them put an office here. So we're not trying to have companies relocate, but if we can find a gap and have them put an office here, that same Kansas City company has now formed 5 joint ventures with Cincinnati-based MBEs, and they're collectively going after like $300 million of public sector work as we speak, but for that Kansas City company, we would not be going after that work. And then finally, in the create pillar, which is the crust of this organization, this conversation, is how do we create more minority firms through the acquisition or the purchase of mainstream or non-minority businesses, if you will, with no succession plan, no kids in the company interested in taking it over. How can we enable the support of more specifically Black buyers, hence the partnership with Black Achievers, and create minority firms through buying existing companies as opposed to everything having to be grown organically from the ground up. There's so much data and information about this out there, depending on the report that one reads. There are trillions of dollars in play from small to mid-cap companies, anywhere from $2 to $50 million in annual revenue, with aging business owners from the baby boom generation, et cetera. Their kids have gone on to do something entirely different, and they have no succession plan. And you think about some of these industries like manufacturing, a snapshot of manufacturing with heavy equipment and CNC machines and all the heavy assets of manufacturing, overlaid against historical lack of access to capital for people of color. Of course, you don't see a lot of minority-owned manufacturing firms in today's landscape. They didn't have access to the capital to create and buy manufacturing companies. But what an incredible opportunity to acquire into industries like that at a time where that manufacturing sector is loaded with aging business owners, kids going on to do something entirely different and no succession plan. And they're much easier deals to finance because of all the assets that can be used as collateral, et cetera. So let me move now into the fund. And I know I got like 3 minutes. I'm gonna tie all this together in preparation for our deep dive coming up in a couple of weeks. So pre-pandemic, we started looking at our own sort of next level around what's missing. And so we have never had, but for a small debt fund that I did inherit, that we, provided some small loans to businesses over some time, but we've never had a significant pot of money to actually invest in minority firms. And so, condensing a long story, we are in the process of launching a $100 million fund that will invest equity and equity-like capital in high potential minority firms. That fund will invest across each of those four pillars that I mentioned, that grow, build, attract, create, but specifically the grow, the build, and the create. The attract one is not necessarily one that we're going to put a lot of money in, because these are companies from out of town that we might from time to time have put an office here. The heavy emphasis of that fund will be in our current minority firms of some size that require some equity funding to maybe launch a new product line or pivot to another industry or bring on some key management personnel, et cetera. So a heavy focus on our existing minority firms. Same with our pipeline. Our pipeline work will also bleed into pretty significantly the tech ecosystem. So much for us to get into, but there's a lot of minority companies that might actually get some seed money from the tech ecosystem, but perhaps their idea was not enough of a unicorn or not disruptive enough to be attractive to a venture capitalist. So that company starts dying on the vine because they can't raise quote unquote follow-on funding. So our fund will invest in some of that follow-on capital for some of these emerging minority firms, and then finally funding these acquisitions. Heavy focus on probably 50 to 60% of that 100 million would be focused on supporting acquisitions. So let me finish up here with a real quick basic structure of how these deals are done. And then we'll take a deep dive, of course, when we have our extended time together in a few weeks. It is, I'm not gonna say it's easy, but it is not nearly as complicated to buy a company per se as a lot of people might think. In fact, in my banking life, some of my clients when I was a banker, frankly, made a living on buying distressed companies with no money out of their pocket and all sorts of things like that. When you're buying a company, this is the typical structure. In most cases, the seller of that business is willing to take a note back because they don't need necessarily, if you will, they're willing to be paid over time. So you'll have a situation where in certain cases, certain sellers can fund the deal themselves. If they're selling their company for $2 million and they don't need that cash right away, I've seen deals happen where the buyer just agrees to pay that $2 million over time because the seller doesn't need the cash right away. And so, but in most cases, it's a combination of the seller taking a note for some portion, let's just say 10, 20% of the purchase, the bank, often financing up to, in many cases, 70, 80% of the transaction. But there's always this 10, 20% equity piece that's still required. And that's where most of these transactions tend to fall down. So our fund is looking to support that equity capital gap so that we can fill out that structure. In certain cases, we'll even take on some of the debt that the bank might look to do. But the bottom line is making sure that we can complete the structure combination, again, typically of seller note, bank, and equity. And so importantly, when you're buying a company, while yes, there's a look at the buyer, but the real analysis is not so much your strength as the buyer from a financial standpoint. It's the financial strength of the business being acquired. So we're looking at the cash flow of the business. We're looking at what are the, for you bankers and accountants on the line, what's the EBITDA, the earnings before interest, taxes, and depreciation? What's that kicking off every year? How much cash flow coverage is the business kicking off? Because it's the business cash flow that's going to repay the seller and the bank, et cetera. And so while yes, what you bring to the table personally from an experience standpoint is really important, but it's not critical that you come to the table with a bunch of financial resources, because the real analysis is looking at the strength of the business or the asset being acquired. This in many ways is no different than buying any other asset, right? And so you're looking at what is that asset throwing off? What kind of cash is it throwing off, et cetera. We then help value that business based on the average cash flows that it's throwing off every year. The general rule of thumb in many cases is, like any other investment, if you start valuing it, can I get my money back in 5 years or so? So we'll often, as a rule of thumb, look at the cash flow times a multiple of 3 to 5 times to say, you know, can it repay that over 3 to 5 years, et cetera. So I know I'm over time. Wanted to give again a snippet and overview of what's to come. We are teeing up. With our law firms in town, our banks in town, our accounting firms in town, whose very clientele are these non-minority firms with no succession plans. In fact, the investors in our fund are many of the banks. So they're not only investors, but they're actually teeing up deals for us, which are in many cases their clients. So let me pause there. I know I kind of went by my time, but in fairness, we got a little bit of a late start for me. So